All right, guys, welcome back. Quick turnaround here. Episode 11 of Invest with Instinct. And you might have seen this avatar around the Twitter streets as of the last couple months with some epic threads, macro investing. If you're out there in the streets, you've probably seen it. So I wanted to welcome to the podcast Alchemist Investor. I don't remember what the actual handle was. Alchemy Finance. Alchemy Invest. So real quick, if you guys don't know him, go give him a quick follow. We've become friendly over the last couple months. He's been nice for me because he's a bit approaches things a bit differently than I do. So it's always good to take in different kind of thoughts, time horizons, outlooks on markets, and really helps solidify some of the ways I think about other things. So welcome to the podcast, and thanks for taking some time out of the day.
Yeah, thank you so much, James. I really appreciate it. And it's been an honor to be here. I'm really excited about your podcast and your work for quite some time. When I joined the Twitter space, I approach investing more on the fundamental angle. And so I'm a portfolio manager at a fund. We look primarily on a long biased point of view. And so really interested in compelling opportunities on a longer term, finding growth investments and that side of the equation. So it was really interesting to get a chance to meet with you a couple months back because even though I look at the fundamentals a lot, I think understanding the right entry points and mindsets and framework about trading is really important. And you and I have mutual friends on the macro side as well. I think more than ever before, this whole game of investing and trading cannot live in silos. I think when the zero interest rate environment, a lot of strategies worked when money was cheap. You could just be gig along or just buy every dip there is, and macro didn't matter. And, fundamentals didn't really matter as long as companies beat earnings and, you had the stock beat and raise and just go up. But I think with the current environment, with how the macro is more uncertain, things are more shaky. There's a lot of interesting tailwinds, but also conflicting themes in the broader fundamental space regarding different technologies and their competition, et cetera. It's certainly a time where I think it requires the intersection of multiple disciplines to, do investing and trading well.
Yeah, I agree. It's probably a very important time for you to. That's kind of my whole point of this thing, is to be able to take some time and realize like what is most effective for you personally. Because if you, like you were saying, there's this long period of time where, and we didn't realize this, maybe you did, but a lot of us didn't realize during this that it was almost like you could shoot a dart at the board and it's going to kind of work out in a way. You could make a lot of mistakes. You could have different time horizons that get kind of bailed out. But as this morphs into this higher rate, like you said, siloed environment where certain assets could perform very well while others get hurt for long periods of time, it's more and more important for you to realize like what type of investor you are and what suits you best and what you're most comfortable in. Because if you're trying to be somebody like me short term, but you're more naturally an alchemist investor, or vice versa, you can end up just being super salty because nothing is going to work for you.
Yeah, that's right on, because even if you look at the broader markets on Wall Street, and so we took a look at this, did a lot of surveys, spent some time on the street, of course, and bottoms up analysis really dominates everything. And it's you made that point where it was crazy that we didn't focus on this before. But it's not just you, it's literally the whole broader investing community. People focused on bottom up analysis, on earnings, etc. Virtually no one talked about the macro, a couple of years ago. And it's not surprising. We see it in the data, right? You saw 2021 and 2022 has been some of the worst years ever for Wall Street hedge funds, right? Mm-hmm. You don't drop 30 to 50% in a professional scene unless you're doing something totally wrong. And, all the people that was so levered long into some of these high beta, high multiple tech names, had no idea that how high this interest rate environment could go. And, with higher interest rate, it's really natural to understand, multiples will compress when we have, higher cost of capital environments. And so, you know, we talk about it now as if it's so, natural and obvious.
Yeah.
But I think back then, I'd be honest, and that's part of the reason why, I was so excited to jump in the Twitter sphere and learn from you, learn from our mutual friends on the macro side, because this is a underserved area where people underestimated and didn't focus on at all, right? And you could see it by how people reacted to just how high long duration yields have gone up, right? And time and time again, people try to buy every dip, but a lot of small cap technology stocks have still been super challenged after
Yeah.
2.5 years since we started to trend down and started to hike. It's been a really painful environment, for many. I think a lot of it is, and we'll get into this, but I'll just close out by saying that a lot of this is masked by, fortunately, in October, November of last year, our friends at OpenAI, launched Open ChatGPT out into the world, and we had a narrative to go after on AI. Obviously, a lot of these large cap technology companies were engaging in the age of efficiency and cut a lot of headcount to push their EPS up, and everyone participated in this AI rally. But if you look at the individual stocks and the breadth of the market, it's still very poor, right? I mean,
Mm.
the Russell 2000, equal weighted S&P, all these indices are down on the year, right? But of course, because the S&P and Nasdaq is so concentrated in the top 7 or 8 names, that just carries the day. But if you peer under the hood, and that's what I do on the day-to-day basis, and really understand various sectors, and then within the sector specific companies, it's a very weak time, right? And you could we'll talk about this as well in terms of IPOs and et cetera, and what that means for innovation. But virtually every risk on sector has been really hurting the past year and a half. And we hope that there's some end in sight when we start to pause, but that's certainly a conversation when we grab some of our macro friends here. But that's the new environment and the new normal in which we have to trade and invest.
Yeah, it's interesting because it paints that picture of like those 7 or 8 companies almost like holding the weight of the financial world on their shoulders. And to me, it begs the question like, can they succeed in doing that while all of the underlying problems, I'm simplifying this, but get solved, right? Everybody reallocates and it's all safe now, while they're carrying the brunt of the work. Or, which a lot of people, you go on Twitter every day, you can see some doom. Will the weight of that finally take those down and create a real vortex of like just interchanging capital, kind of people trying to figure out where the safe assets are. It's hard to blame, like, it's, well, you can blame the funds, but like it's a little bit hard to blame them because they were essentially, everybody was kind of told by the big guys that interest rates aren't going up, like it's there's not there. This isn't like you had to really take a leap of faith in your abilities and history and conviction to kind of fight that narrative of no, rates actually can go up. Things could change. There can be inflation. And I feel like only now am I, I guess sentiment wise, feeling like everybody has finally come to that conclusion that like you said, now it's almost obvious. So now I kind of wonder, like, have we gone too far mentally in switching completely to the other side, in which you have to start looking back the other way, if this makes sense at all. It's almost like we've crossed that chasm.
Yeah, no, you put a lot of insightful points in your message there. I mean, there's a lot of it. I mean, if you just look a couple years ago, and this is why every time I talk about macro, I just wanted to be humble and say, no one can predict it. The people that control the money, Powell and Yellen, themselves, have gotten it so dead wrong. I remember about 2 years ago in mid 2021, that was when that was the first sight of the crack in the armor, if you will. I don't know if you remember summer of 2021 when equity started to dip a little bit because
Mm.
people realized with all this money printing, we might have inflationary concerns. And then Powell, Yellen, Kathy, you name it, came out that inflation is going to be totally transitory. We don't have to worry about raising interest rates one bit, right? And then fine, people scoffed it up. And then September, October, November, we had the rally of the ages, and that marked the top. And crypto went to Bitcoin went to 69,000. A couple months after we thought inflation was transitory, only to wake up 3 months later, when we started to commence plans to hike interest rates, right? And so it's just it's crazy to think in the moment. Now looking back, it's so obvious, but in the moment, it was just so difficult to see because we haven't experienced this for almost 2 decades. These types of rate hikes have been quite unprecedented, right? And people just don't understand that. And so I think that's one part that is really important to say. On the other point that you note that really stuck out with me was, if you look at all the big caps, with these 7 or 8 names, can they, withhold the entire, global markets, if you will, while, shit gets figured out. I think, it's important to realize the strength of these mega caps because, they have large balance sheets. They could really play into the AI narrative. um, they're less rate sensitive because they don't need reinvestment capital. They literally print cash, and in some cases, on the Nvidia side, the demand is real. They literally grew free cash flow over 500%, right, over the course of the year, and so that all is real, right? How long can this keep up in terms of the velocity? I don't know, but in terms of the demand there being real, there are some pockets of innovation where it's true. I think on some cases, though, you know, you could look at the Facebooks or the Googles of the world, the Netflix of the world. A lot of them had this meteoric rise this year because back 1 year ago this time we were at rock bottom sentiment with tough comps because 2021 the comps were looking really good, obviously, and then in 2022 obviously people failed to beat those guidance and those earnings of the previous year. So you've been dragged down by that. You've been dragged down by negative sentiment, and also Mark Zuckerberg was talking, hey, I'm just gonna in this macro uncertainty, I'm just going to invest in the metaverse and VR and stuff like that. And so a lot of companies were still kind of this in betweener phase, if you will, kind of stuck between mega growth, but then now rates raising and people didn't know what to do. And so we got out of that by basically cutting. This is one point that I've mentioned before on Twitter, but doesn't get talked about enough, which is the whole white collar recession. If I look at my friends coming out of awesome institutions, going into tech or into finance, it's tough to get jobs because a lot of these large cap companies have actually been laying a lot of people off, and that age of efficiency, if you will, which is a euphemism of just laying a ton of people off because we realize we don't need that many people just sitting around in tech getting free food. That cutting of labor allowed these stocks just to compound EPS at unprecedented rates, and that just lifted stocks up. But you could only cut your way so much to get your
Right.
stock up, right? It's just like all these personal finance gurus can say you can only save so much money to get rich. You got to actually make it. And so I think the pendulum has swung from just cutting to now. Once we go through the Q4 earnings for 24 and beyond, we can't cut our way to EPS now. We got to actually create new earnings. And so um, 8 companies cannot withstand the whole global market equities. We need, smaller companies, smaller software companies, cloud companies to reinvest back into these enterprise customers to push earnings up, right? If that doesn't happen, things will start to get tricky, right? And so the hope, and we're literally deep into earnings season right now. The hope is when we get these earnings, we listen to these CEOs talk about guidance, they can give us some information and paint a picture that says, okay, these software companies, these cloud guys, these smaller cap names are ready to reinvest back into our business, because mega caps can only grow so far from cutting. You need growth. And so that's literally what we're looking for. And that will really dictate how, 2024 is going to look out for us.
Hmm. So basically, there's no like trap doors left for them to sneaky levers for them to pull on. It's like put up or shut up at this point.
Yeah, that's right. I think most people used a lot of the sneaky levers, if you will, of just rock bottom sentiment, cutting a lot of staff, so you just juice up the EPS, buying back stock. Of course,
Yeah.
it's direct juicing up EPS, and so there's still some of that folks can do. And of course, we saw it too, actually, not too far ago. I think this actually marked the top for Apple as a stock. It was back in mid-July. I remember it so clearly when I was on the Bloomberg terminal, and the whole street was going crazy that Apple was saying, hey, we're gonna, it's not even saying that we're gonna um make something in AI. They said we're going to invest in AI and then hire someone, and then the stock juiced up to 199, and then that was it. Right? That was literally the top for Apple of the whole year, right? And so so in terms of laying off people, buying back stock, and mentioning AI, those are levers, and I think you know it's been a spectacular run, right? Even after this correction, the Qs are still up 35% on the year. Mega caps are up 55 to 60% on the. I mean, it's amazing, right? The growth, but you can only do that so far. So Q4 and beyond, what I'm looking for is real organic growth now, and that's what we're all hoping for a um, strong year going forward. And if not, things will start to be difficult. So
Yeah. It's really interesting to think about the whole hindsight thing, the whole it's obvious now thing, because like I remember when Meta was, I think, 80 something bucks, right? I don't
yeah,
remember
that's
what the
right.
low was, but it seemed so obvious at the time, right? Like, yeah, this is trash. Nobody uses it. They went all in on the metaverse. It's for boomers. It was basically just a stomped on, and everybody hates Zuckerberg. And then here we are, and everybody's like, Zuckerberg's going to be, fighting Elon in the Coliseum. Facebook completely trashed the metaverse and has these new sick AR things. Like, Facebook's back on top of the world. And you're like, of course, like it was too big. Like they had everything buttoned up. Like they have cash. They like got rid of some of their workforce and made things more efficient. It's funny just like how I'm seeing that mentally play out, because I don't really trade individual stocks, and I only see these instances on like order books of like a commodity or something. But thinking about the like public perception of a big company, and not even being able to imagine where they could possibly be in a year, which is like now I couldn't have imagined Facebook being where it's at now back then, right?
Yeah, that's right. I think it's you bring up a really interesting point, and a lot of times, I see a lot of traders use this, but a lot of times just the price drives the narrative,
Yeah.
right? And just because it's gone on an amazing run, it just drives the optics and the strength of the company. I think Facebook is one of those examples, um, that looking back was a miss for many funds I know, because it was a name that was obvious in terms of being oversold. Because and I'll explain why. If you just look at the free cash flow generation and the balance sheet of the company and the multiple at the time, right? It was basically trading at multiples of a never growing stock. If you did the DCF on it, it's basically um, this stock had no more terminal value, right? Which it's insane, and that's why this is
Sure.
another point we could always I love to talk about, which is people talk about the efficient market hypothesis. That's such bullshit, right? I mean, it's not efficient at all. I mean, this Facebook was trading at 85 bucks for like a month, right? And anyone could have bought it basically. But I think one thing that was interesting though, where a lot of people saw it but still um, didn't have the wherewithal to buy, was twofold. I think one, let's just be honest, most people got their positioning wrong. And so by the time you saw Facebook at $85, most funds on Wall Street were already down 25 to 30%. And so they couldn't tell their investors and their limited partners that, hey, we're going to pull out more money to invest in stocks at
Mm.
this time. Because when you're down 30%, if you're down anymore, if you get that Facebook call wrong, because I don't know, everyone from Jamie Dimon was calling for a recession in Q4, Q1 23. If you got that wrong and Facebook just went to 50 just because, then you're out of a fund, right? And everyone's out of the job. So people were just too risk averse at the time. So I think a lot of times, I see this in crypto. It's kind of funny. You buy the dip, but it keeps dipping, and then when it gets to the final dip, you've lost all your money that you're already fully deployed, so you can't really buy
Yeah.
any more at that bottom. So there was a lot of that, what I would just call, systematic and positioning, where it was just unable to get more exposure at that point. The second thing was more on the fundamentals of the company. um, Mark Zuckerberg was, I don't know if was he high or he's smoking, but that earnings call, he was talking a lot of nonsense. I mean, the macro was all time low. S&P hit 3450, and and it seems like he was a billionaire in his ivory tower and saying that, I don't care, I'm just gonna invest in VR. I don't care if I burn money, I'm gonna burn even more of that. And so people just thought, okay, this guy is a little bit detached from reality.
Mhm.
I got to give a shout out to some of the close investors, like Brad from Altimeter Capital. He actually wrote an open letter that many of us read, was basically saying that actually, people can be a little bit activist on Facebook because they have so much potential to be unlocked. All they have to do is just table the VR dream just a little bit longer
Yeah.
and just reduce cost, right? And that thesis was actually very clear. If you read it out, people understood it. But I think it was just one of those um, instances where you say, the faith in management and faith in the team and the people, just unfortunately paired with rock bottom sentiment, allowed people to come to their senses from the investing standpoint. People just thought Mark was off the rails at the time, and you come up with a very clean open letter that made sense to anyone that could build a DCF model. But people were just thinking, oh, this guy might not do it. Um, but lo and behold, Mark Zuckerberg's a competitive guy. He realized, he's dropped so much ranks on the Forbes list that, okay, maybe I should just, you know, do what's rational and cut cost, and that's exactly what he did, right? And Mark Zuckerberg kind of led the way to many of these mega caps and allowed this rally to happen, which was this whole year, which was the age of efficiency, right? And basically, you
Mhm.
just cut your way and buy back your stock your way into juicing your EPS to compound your stock price. And it worked fabulously, right? And you sprinkle in some AI pixie dust and some FOMO, and that's how you explain to get where we are, right? So the
Yeah.
price action here is actually very rational
Mm.
for Meta, but I think, and hindsight is always 2020. It's always hard, right? There's less of those, obviously oversold mega caps right now, right? And but
Yeah.
there's still a lot of room, and I'll table this because I would love to hear your perspective here. But there's still a lot of opportunity, right? And if you pull out the fintech space, like the Squares and the PayPal's of the world, they have absolutely pummeled. They're like down more than 82% from their all-time high and haven't caught any of a bid this entire year. So
Yeah.
there's some of those setups now, which we could talk about. But in terms of an obvious mega cap now, I think things are priced, quite fairly. And the bears of the world would say, "Oh, of course, things are
Sure.
expensive." But
Yeah.
that was kind of like the backstory of Facebook that I wanted to talk about.
No, that's great. Yeah, and like with the whole efficient market hypothesis or theory or whatever, I'm assuming that it's more about over long periods of time rather than these kind of anomalistic events that happen where, like, Facebook at 80 is just like Facebook way too high, and over time that it kind of uh, finds its way to what may be more of like a homeostasis, like maybe like we're at now. But anyways, so I'm interested, like during those times, you have Facebook in this situation or whatever, and you are a value investor. So are these the times that you guys are actually the most clear-headed and able to really think through without being biased towards like I have to imagine there's certain times where a value investor is like getting really frothy at the mouth when a price keeps dropping and dropping, and it's kind of coming right into your wheelhouse. So how are you starting? How do you kind of like sit back, be patient, and think through these value type of plays in a moment where there might not even be that much time to act? Is it more on planning, pre-planning? How are you feeling during the moment, and how are you acting on that? And maybe, PayPal or something is something you've been talking about recently that I've been interested in.
Mhm.
A scenario that's maybe hanging out there as an opportunity, and this one's had like a much longer life in the trenches. So how do you think through that process of seeing things go down and how you're feeling in those moments?
Yeah, for sure. As I guess one quick edit, and I would um, call myself a growth investor, not a value investor. But
Sorry,
but for sure, during that period of November,
what an insult.
you
Oh,
know, growth
my
growth
bad.
and value were clearly intersecting, right? And when you have growth and value together, man, light bulbs just go off, right? And so I think for us, stepping back a little bit, on the growth side, the primary tenet is to always look for, interesting, secular themes. And I don't want to bring it too far back, right? But if you think about engines that have moved markets, if you will, right? It's always been technological paradigms, anywhere from, the first railroad stocks to electricity and light bulbs to telephone, landlines to, um, the first generation of personal computer, then to internet companies and to mobile, and now, AI. So each of these paradigms are super important. They all, you know, connote this paradigm of technology, if you will. And if you go even farther back, before we had the Industrial Revolution, things that kind of permeated everything was energy. Everyone's sort of looking for that new paradigm, that new energy, if you will. A lot of people think this day and age that new energy is platforms, be it software or hardware infrastructure that permeate, AI platforms, right? And that can't be more true. If you just look at um, most of the most powerful nations like China's of the world, everyone's trying to get into, AI. Xi Jinping has launched a national, AI initiative to, build that technology as well. Obviously we've seen, us trying to, combat in that debate, if you will, by Biden, banning, Nvidia AI chips from shipment. And so you could tell how strategic this asset is. It's not only a technology paradigm, but it's actually a geopolitical strategic asset. But anyways, we're always looking for these, secular themes, right? And so, be it AI was always a theme we've been tracking a long time. Things like cybersecurity. There's areas of innovation in biotech that are, super powerful. So on and so forth, right? And so once you get those themes down, you have teams of people that are, digging into the sectors, talking to experts, understanding what's, you know not only hot from a technology perspective, but what's actually going to translate into becoming a real business, right? you know make um, make the market map of those categories, understand it super deeply, better than any equity research analyst on the street, and then you come up with price targets, right? And know that the price targets are artistic, right? They're not the end all be all, right? I think people that got so stuck with their price targets were the ones who got caught with their pants down in 2022, when just interest rate went straight up and multiples went straight down. Then your PTs, no longer made any sense, and the PTs just naturally drifted downwards as cost of capital went up, right? But so a lot of it is just going. tops down from the thematic standpoint of what's interesting sector wise, and then bottoms up and doing the individual work both on the technical side and on the financial and business side as well. And so once we have that, it goes back directly to your question. In October, to be quite frankly, many things were very cheap, right? And so, I'd highlight that that was a certainly we were very fortunate. It was a generational buying opportunity, for semiconductors as well. No one would have predicted that, Nvidia was going to grow free cash flow, 500%. No one predicted the demand of the AI narrative. All we knew that this was a high quality company that has been expensive for a while, and it's hard to ever justify owning a stock like Nvidia at those multiples. And this was pre, the H100 AI chips hype cycle. And so this was after Nvidia came down almost 60% from its highs. And so, it was right at our price target, and we accumulated over the course of, many months to say, okay, this is a high quality asset that we wanted to would to buy. We think we could easily, double maybe in a year or two. But it was going to be a high quality company to own regardless, because it's a stalwart in the semiconductor space. And so I say all that just to say that, a lot of times you could do your work on the science, you could do your work on the business, and it comes to a PT that you like, and then you buy it. Where it goes and how high, right? Let's be honest, no one really knows, right? The funniest thing is when you see price targets from, sell side firms at Wall Street.
Yeah.
As stocks go up, they just keep pushing up their price targets,
Yeah.
right? It's meaningless, right? And so
Yeah.
I think if people that were just honest and just been around the block long enough, that, PTs are meaningless. So what you do is just you just know that risk reward is in your favor if you invest now, and then you go from it, right? And that's why I've been so glad to meet you and hear from your perspective on trading and frameworks, because I think a lot of investing, even on the fundamental side, requires a lot of this, trader mentality. Everything's a trade, right? I think
Yeah.
you just have to admit everything's a trade, because eventually you have to get liquidity somehow, right? Unless
Yeah.
you of course, you could say that, oh, an Nvidia or Facebook could be a long term hold. Yeah, sure, but you gotta liquidate somehow, somewhere, right? And so, based on the risk reward, we just piled in to the right sectors during that time, and that paid off. But that was a long-winded answer to your question, which is, a lot of it starts from thematic understanding, and then from the themes you narrow down to hottest companies, and within those hottest companies you try to find monopolies with each of those sectors that make sense from a price standpoint, and then you just go in and hold long term.
Fucking monopolies. That's the answer.
Yeah.
It's just monopolies. It's funny though how I like to think of the Nvidia thing, right? You guys had this plan with a lot of things, sectors, companies you're watching, price targets. You get in, you're hopeful that it's going to work out due to all the due diligence and your plans, and then Nvidia goes on this sun run, and it's quote unquote lucky. Just like interesting how like luck works when you're in a position, right? Like uh those are just the absolute, like there's skill in there, there's luck and skill. And I like to think of what just happened in Bitcoin in the last day or two. It's like
Yeah.
people have kind of been planning and accumulating, and whatever their reasons are, whether it's cyclical, macro based, global liquidity, just maybe it's the idea that it's just down X%, I want to buy it. Like the ones that are enjoying being long during this lucky breakout, that a lot of people hate. Sometimes it just happens when you don't plan for it to happen, but you kind of, that's part of it, right? These things happen. And hopefully risk reward wise, like if a bad luck event happened, um, but you had been patient and planned out your entry points and all of that, like you're not going to go bust. Whereas if somebody were to now buy into crypto after this little push through 32 up to 35K, now they get in long. hoping for that luck to continue, which it could, and maybe it does. Now you're opening yourself up to the bad luck event, which in actuality is rooted in bad planning and FOMO and greed and fear and all that, which your Nvidia play is way less likely to experience. And if they did experience, um, you probably just have an exit plan, if that makes sense.
Yeah, that's spot on, and it's all just risk reward, right? I
Yep.
think when you invest, sure, you could do all your due diligence and fundamental work, and we really do have a recession, right? Yeah, Nvidia could have gone from $140 to maybe 120, maybe
Mhm.
even $100, but at that point, the downside is limited because just based on the fundamental work and the pure financials of that stock. I mean, there's just going to be a fundamental value basis, right? And that's why when you get into those moments, it doesn't happen often. For people that were really patient, and I'll be honest, not many people were on Wall Street, but when you get to those levels, and you get to points where even value investors think the inherent terminal value of this business is withheld from the cash or the assets alone. Okay, yeah, that's starting to that's starting to be a point where it's hard to bottom much more from there. Then you could just buy and accumulate, right? It's kind of like, and actually, spending time on the crypto space, obviously I don't do that professionally, but spending time on the crypto space actually taught me a lot about that, because precisely in crypto, you actually cannot you cannot FOMO trade. And in fact, that reason of not being able to FOMO trade teaches you a lot of just how to trade and invest in general in any market. Because if you look at the moves of Bitcoin, right, and I wrote about this today too. Would love to get your opinion on that piece offline. But basically, if you just look at the price action of Bitcoin, it just, there's a primary impulse. Literally, let's say 2023 is when we started. Bitcoin, all the bears were in disbelief. It ripped in our face for a week straight, nonstop, right? A week, maybe two, and then people thought, oh, okay, maybe it's time to get in, and then no one made any money because it just went sideways for a long time. Same with March after the SVB dump, ripped straight up, and same thing happened in July, and probably this time too. We it caught everyone off guard because it happened over this weekend, right? And yesterday, and ripped up. Um, so basically, who wins? The people who win are those that are long term accumulators. They invest and they buy when it's boring, and um, you know they win when these quote unquote god candles, as crypto degens love to call it, happen.
It's a great name, you got to admit. Great
Yeah,
name.
god candles. Yeah. But I love looking at investing kind of like these god candles, in the sense that it forces you not to chase, right? Because that's literally the only way you make money in crypto. You can't chase these god candles. You have to be positioned well beforehand. And similarly, you know, for Nvidia, for cybersecurity names, or for whatever fundamental sector that you're interested in, you have to do the work beforehand. You buy when it's boring. You buy when things are low. Obviously, we could talk on subsequent spaces and things like that, on in terms of how we look at that. That there's particular indicators, there's particular macro and fundamental signals that we look at. But anyways, when it gets close to an interesting buying point and it's boring, that's a gift. You actually want to take action there when it's boring. You don't want to take action when things are exciting.
Yeah.
Um, and we saw that play out so beautifully again the past 2 days. And and for long term Solana bulls like yourself, those are days where it's nice, right?
Well, it's like I've studied the Solana space for a while. Kind of like you, I feel like it's going to be around a long time, and in the end, I am unsure of what company or what app or whatever it will be in Solana that makes it. Um, but the underlying coin can do well if this space does well. So just like you, I'm kind of like I was biding my time, and hopefully we'll eventually kind of reap the reward. But like I this is a perfect example of like positive reinforcement and like negative positive reinforcement. So, for you, you've been doing this a long time now. You're getting this positive reinforcement every time you find an NVIDIA play like that. And, I'm sure they don't come all the time, but like every time you have that patience, you get that entry that you love. Maybe you average in a little bit more and then eventually it works out. It's just hammering home the right thing to do, over and over and over so that you in the future are not going to be chasing or whatever. You're going to be like, nah, I've seen this a million times. Like every time I know I've been through enough of this to understand that like when I'm reaching and when I'm playing patient game. And then like the opposite, the worst thing that can happen is somebody buys Nvidia at, I don't even know what the price of Nvidia is. Let's say it got up to $400. The worst thing you can do is buy it $400 and have it go to like $700, right? Because, well, okay, in that moment you might have just had a great trade, maybe you even exited up there and you have a good profit, but you just reinforced one of the worst things you could do, which is buying post God candle, hoping for another uh, heavenly candle or whatever you might hope above that, right? And that's just what everybody did with the GameStop shit and whatever is they're buying like expanded volatility, hoping that it expands even more. So it's like crypto, like you mentioned, is like this perfect pain trade all the time, every direction. Where if you make a mistake, it's just going to expose you every time.
Yeah, that's so right. And unfortunately, there's not many instances where I FOMO chase and I get rewarded. So for better or for worse, I think the good habits stick because it's been very painful. Every time I FOMO chase on crypto, I quickly learn my lesson. But it's
It's
a
funny
good
because
thing.
everybody kind of gets sucked in still. It's hard. It's really hard to like to not sometimes.
Yeah, I think those are, and this is not a jab on crypto, right? I think I'll just put out the bat. A lot of, I think we could all agree, m- many parts of crypto, dare I say, majority parts are scam coins, but
No.
there are a few parts that are actually very meaningful. There's some L1s, you say Solana. There are some DeFi protocols that could be game changing, and of course, the digital father himself of digital gold. Um, on Bitcoin, there's certainly a lot of use cases, right? But I think the funny thing is, on the crypto side, um, you basically have to stick with the um, right frameworks, right? Because there's not a lot of fundamentals that are kind of driving it. It's a lot narrative driven, right?
Mm,
And so because of this whole narrative driven thing, when things are good, everyone and their mom thinks Bitcoin's going to go to 100K. When things are bad, people are like, "Oh yeah, this is obvious. I always knew it was a scam coin. It's going to go to zero at any moment." Oh, not only that, the exchanges are not safe. Pull out your money from
yeah.
Coinbase, right? And it's precisely that moment where you want to pull out all your money is when you should actually average in more, right?
Mm-hmm.
And it happens every time. That that's why if you really want to succeed in crypto, you gotta force yourself to be disciplined and patient and live through the cycles. This is such a counterintuitive game and like a pain trade type mentality of price action, so to speak, that if this is your first cycle, if you will, it's so counterintuitive that it's pointless, right? But
Yep.
if you've seen the cycles over and over again, um, it's kind of the only reason why I mentioned like it's more narrative driven and most things lack the fundamentals is that it's so it's so game theorizable because it's very sentiment and narrative driven of a sector. So it's a perfect area for a trader. So I know you're a long term Solana holder, but I'm curious if you trade more into crypto professionally because it seems like it's right up your alley.
I've thought about it. There have been multiple times where I've thought about dropping everything I do and just solely trading crypto. Um, I'll be honest, generally the crypto markets don't interest me as much. I've gotten too into the like whole macro side of things and how commodities work and all that. I do agree with you that it is probably a trader's paradise in the fact that it's still wild, illiquid, narrative driven. Um, the thing with narratives that's really interesting about them is I think I don't remember who said this. It was some big investor, some big fund guy, nothing to do with crypto. He was like, "We work on different time horizons, right?" I don't know if it was Druck or somebody. But it's basically like he has like his 3 to 6 month bucket, his like 12 to 18 month bucket, and then his like 24 month and beyond bucket, and they trade different assets in different ways due to different data. And I feel like in crypto you need to be really good at that. Either you need to have like a long-term conviction in which you just don't touch it, right? And then you play in that long bucket. But if you're going to start getting in the weeds and trading Twitter narratives and ETF releases and meme coins and all that, you need to be able to really efficiently be like, okay, this is part of my like really short, hyper short term bucket, my 3 to 6 month bucket, or my year plus bucket. And then you need to be able to decipher which narrative is on which time horizon and how is that, like, is that conflicting or helping? Because if you're not doing that, like, everything will go wrong all the time. So I don't think I'm that good at narrative trading, and nor do I want to be forced to spend more time diligently following all of the stories of all these things. So it's one of the reasons I try to stay away from the short term slinging it around in there.
Yeah.
And also I do like, selfishly, I always thought, oh, I'd love to have 24/7 markets. Nah, I kind of like the structure of just normal markets and being able to tune out and live my own life at the same time. So I've kind of stayed away, but I'd be interested to hear your thoughts on like because you kind of play in the long bucket only, right?
Yeah.
So you're able to kind of avoid and almost like giggle a little bit at the hyper fluctuations. But man, some people really thrive on that.
Yeah, for sure. I think, first of all, I focus, more professionally, just 100% on traditional equities. Um, but on terms of the crypto side, and certainly have exposure in my own personal portfolio into crypto. Like you, I'm also big believers in certain alternative L1s and just with all the geopolitical situation going on and just the whole zeitgeist and narrative, so to speak. You got to have some crypto, ETH, Bitcoin, Sol, pick your favorite L1s, if you will. But I really see it as a call option hedge into the monetary policies and the institutions that we have. I see it as a call option and higher beta play in terms of technology and just risk on assets. And so when I actually you could call it where left bell curve and right bell curve kind of intersect, if you will. But I play it very simply. When there's max fear and RSI and sentiment is low, I just buy. It's just a dollar cost averaging plus plan,
Yeah.
with some discipline, if you will, and that's what I do. I haven't sold any coins over the course of the year that I accumulated, and I'm just playing for the next bull run, if and when it happens, right? And
Yeah.
this is totally off topic, but for some people that are interested in quick bucks or gains. I mean, there's crypto is like a playground for that. There's still so many people making money off of meme coins, and it's very low liquidity. These are not things that funds can participate in because
Yeah.
most funds can't even invest in that tiny of a volume. But it's interesting to see what's going on in there. I think the reality is, if you talk to real crypto natives that are building, um, a lot of these projects will end up going nowhere. But the few of them that does, and they stand the test of time, right? Like the Solanas and the chain links of the world. There's still a lot of developers that are building on that. But anyways, yeah, that's on the long and short of it, and in terms of the daily volatility of crypto. Yeah, I don't really pay much attention. I think it's I think it's a losing game unless you have some type
Yeah,
of
it is a
system.
losing game
Yeah,
for sure. Yeah, I mean, that's just trade. It's just trading, right? Like
yeah,
a fucking losing game. I mean, the negative, the one like thing that runs through my mind all the time is there's so many billions of dollars in crypto that is still allocated to the trash that like how does that money dissipate? Is it because there is an event or a regulatory situation that comes that basically everybody has to pull all their bullshit, suck it up into the main assets? Or do we have to experience another like massive wreck market wide to get rid of all that? Because it bothers me that it's all sitting out there in this scammy type of shit, and I just
yeah,
don't see how it can evolve to what we want it to become with that, like getting away with that. You know what I mean? Like
yeah.
I don't. That's like my big looming concern is like
Oh yeah,
how Pepe or whatever or even Shiba Inu or whatever this meme coin has like billions of dollars in it, and I'm like, how do we reach escape velocity with Bitcoin becoming an important thing in the world with that kind of like just being okay?
yeah,
um, I don't know. It's just been something running through my head, but it's like I just can't keep coming up with reasons to like not be a part of it. I just got to forge the way forward, you know?
yeah. No, that's such a profound question, man. I'll try to answer on the crypto side first, but I will say this is such a deep, important question for all stocks and asset in general, and I'll definitely compare to a lot of the things that I'm looking at on the traditional side as well. I think the theme that you talked about it cannot be, more true applied to assets broadly, right? I think crypto is bearing the brunt of all that, right? There is a lot of high quality VCs, Andreessen Horowitz, Sequoias, if you will. Everyone, got their taste of illiquid crypto assets, right? Everyone's invested into these
Mhm.
these names. But the problem is if you invested into these projects on the private token level and they're still not um, you know, quote unquote public or there's not a liquid coin that you could trade, your money's kind of stuck there, right?
Mhm.
And it's a liquid. It's just like it's like us normal people buying a house, and then the entire city hall and city just got burnt down, and you just have a kind of like a worthless house, right? you know before the city burned down, that house was worth $1 million. Now that there's no functioning water or anything, it's like you know it's like a 50K house, because that's like the price of the wood and whatever the premium is left in that thing. So it's similarly to a lot of crypto companies like you talked about, especially the meme tokens and stuff. There was so much money printing, there was so much money that flowed into these top venture capitalists that wanted to get yield, and they flowed into these scam coins. And now there's no way to get out, because if you pull it out, you would ruin the project. And I'm not saying that these VCs are magnanimous. No, by any means, they're not running a charity shop. But if you do that, then basically the performance of your fund will suffer immensely, because you have
Mhm.
to take a massive drawdown and markdown and tell your investors you lost all their money. The prudent investors and your LPs on your cap table will know that, but at least you could say that, no, hey, we still have money in there. Um, Trust us, guys. In 2024, the bull run will come, and then dumb retail will provide us exit liquidity, and then we'll hope and pray to God that we could pull your money out and give it back to you, right? And so a lot of people are doing that, but this is not dissimilar to many other more
Startups,
traditional.
VCs, and
Yeah,
things like that.
yeah,
Yeah.
exactly. Look at all the startups that were formed in the past 2 years. A lot of a lot of amazing technology companies and startups that were formed, but maybe you don't need the 20th or the 30th
Yeah.
AI chatbot app. So 25 of those companies will probably die. So same thing, right? The same thing in digital health. I know this is more a niche industry, but I think everyone has heard of Teladoc. Maybe people have heard of Livongo, but they do like a nutrition and diet and diabetes obesity kind of monitoring play. And at one point, when Teladoc and Livongo were combined, they were like a $40 billion market cap company.
Mm.
And then now, post acquisition combined, believe it or not, you went from 40 billion for a price of two companies. Teladoc by itself now is worth $3 billion, right?
Wow.
And so it's just catastrophic destruction to the digital health sector. And why is it catastrophic destruction? Because every mom and their startup and every VC and the SoftBanks of the world that were investing into these health tech startups, they pegged this as a comp, right? So Teladoc was worth $40 billion. So I don't know what the multiple was at the time. You could make it up. There's like, oh, they're trading at 50x
Oh, I
multiple,
see.
right? And so our dingy little startup can trade at 100x multiple because the growth rate is even higher. Well,
Mm.
then you have everyone making, you know, only $10 million of revenue with no growth prospects, but all worth $1 billion. They were all unicorns, right? That's why people said in 2021 it was the birth of most unicorns. But that's fake money, right? It's that unicorn valuation was as real as Sam Bankman-Fried being worth $20 billion, right? Of what? Yeah,
Mhm.
of $19 billion of Shiba Coin, right?
Yeah.
So there's a lot like that, and that washout is what we actually need for the sector.
Yeah.
And I think that washout is also true because I spent some time on the biotech side as well. If you look at the biotech index, this is a ticker called XBI. It's really interesting because this is the one ETF sector um, in the entire stock market where the majority of the tickers in this basket do not make any money. And so how biotechs make money is that they get acquired by large pharma. So they are like the R&D engines, if you will. So you basically pay money into biotechs so you could run their clinical trials. If they're good, a Pfizer, an Amgen or whatever will just buy you out. And then, you make your money that way. But the problem was akin to crypto having so much excess capital, people had all this excess capital to flush into all these random science fair projects in biotech. And because there was so much money in the capital markets, um, all these all these companies in akin to these scam coins, were listed public, right? And so
Mhm.
many of these science projects were went IPO, and then people 2 years later realized, wait, these are like science projects. Most of these drugs don't work and we're not going to invest money here. Why? Who in their right mind would invest money into a biotech company that takes 3 years to get any clinical product out from a clinical trial perspective?
Yeah.
If you can just put your money in treasury markets, and in 3 years, you would compound, 5.5%, to the power of three already, right? And um, so that whole sector is getting annihilated, and
Looking at the chart right now, it looks pretty bad. Yeah.
it's pretty bad. And so on the biotech side, it's a similar thing, similar point to you mentioned in crypto, which is like it's very sad and unfortunate, but you kind of have to hope for things to wash out so that all the science fair projects die and
Yeah.
all the capital will be reallocated into actual real therapies that make real money, right? And
Yeah.
similarly to crypto, I don't know what that event could be, but we really need to get, you know, tens of hundreds of billions of dollars out of meme coins and back into the projects that actually matter.
Yeah, I feel like it needs to be almost like we need a Jerome Powell of crypto to come up with some sort of regulation that basically shuts the door uh, or starts closing the door on scam coins and opening the door for the main movers and like a nice, we'll call it a soft landing, a
Yeah.
vacuum of liquidity back up to the top without a shattering across the board.
Oh yeah.
But
Oh
we all
yeah.
know
I
how
mean,
hard soft landings tend to be, I guess, right?
yeah, that's tough. I mean, that's a really long discussion. Hey, maybe when you're free another weekend, that could be a nice spaces discussion. We could bring some crypto people on because I think that's a big idea that
Hmm.
keeps me up at night, and I have no idea how people are gonna be willing to solve it. I think the low hanging fruit idea is just like you know, you just kind of think of that money as water under the bridge
Yeah,
and it's just stuck in there. It's dead money. You just write it
dead
off.
money. Yeah,
And when the new bull run comes, you're just going to attract a new line of suckers to give us liquidity and people that been through the cycles will just pull their money out and hand it to the next sucker. That's the low hanging fruit answer, right? Um,
Yeah.
and most people are trying to play for that, but yeah, the to do it logically, I think it's tough.
Yeah, I suppose it's just a little bit more obvious in crypto, right? Because everything's on chain, everything is publicly available, market caps, whatever. And in the VC space, private equity, like it's all a mirage. It's smoke and mirrors. You don't really know unless you're deep in the space. You don't see all that dead money as obvious, even though it's all out there too.
Yeah, that's precisely right.
Hmm. All right, well, we can wrap this up soon. Let me ask you one more question, and just for people out there, I thought this was an interesting one because I don't know how long you've been doing this, but let's just say it's a while. And if you were to give advice to somebody who's, let's just say they haven't been doing trading or investing for longer than a year, what would you think is kind of the most important thing for them to figure out? And that can be psychologically, it could be tactically, it could be whatever. And then what about kind of that, let's say, 2 to 5 year range where you've figured out maybe how to make some money and you have a little longevity. And then if you want, you could even go into the longer, like, hey, you've been here a decade. What are the things that the people that have been here on that long are really getting better at? So those three buckets. Any thoughts on that?
Yeah, for sure. So I've been doing fundamental investing for over a decade professionally, and of course, when I was young, looked at a lot of stocks and was interested in VCs and startups for quite a while. I would say for people just starting out, um, you know, there's two ways to approach it, but the main thing, if you're really serious, because I don't want to discount people that want to get started. So if you want to do it the right way, and you believe that you're gonna really take the discipline and the education to learn it and just to do it the right way. It doesn't have to be professionally, but even if you want to do it on the side the right way, um, the first thing that you figure out is what style of investing are you? And funny enough, you gave me that quiz, which you could send it out to your viewers. I think it's very important because um, if you are a trader slash if you are a long-term investor and that's what you want to become, the skill sets that you learn are very different, right? And so from for year one, I would say if you're serious, learn your style. Do you want to be a trader or long-term investor, right? If you want to do long-term investing, then you got to do the basics, right? Like read your intelligent investor, learn how to read a financial statement, learn how to build a DCF model, learn what comps are, values are. Pick a sector that you like and learn it. So I would say, learn from the grounds up. And obviously, this is a much longer conversation, right? If you want to be a trader, same thing, understand what type of trader, right? Are you a day trader, a swing trader, a tactical one? And from there, kind of understand, what best suits your style. Do you want to learn all the, technical indicators, learn how to really calculate risk reward, learn how to find entries, and then just practice from there, right? And so those are the two diverging sides if you're year one. I think one quick plug there before I go to the next bucket. The the quick plug is if you realize that you just want to be involved in the markets just to make some money, but you don't want to spend that much time, then just forget everything we said. You know, don't follow my channel. Don't even follow James, and just listen to Buffett. Dollar cost average into the S&P 500. Open a Schwab account. Do automatic investing. Go into S&P and QQQ. Dollar cost average the same amount every month, and you'll be fine. If you want to be more cute, you could dollar cost average every 2 weeks to get a better, cleaner average, and then literally don't talk to us for the next 10 years and just you can say thank you later, right? And forget everything we said. So there's but anyways, I
Probably will
assume
outperform me, to be honest.
what's up.
It'll outperform me, to be honest. But
Oh, and probably me on the long run too, right? So but yeah, but I assume, James, you were asking about people who want to take this seriously. So that was the year one. I think the year 2 to 5 is just you know this is the time where after you've done your learning, you've been scammed by enough, Twitter gurus and Discord channels, and you realize those calls don't make you any money. You do it yourself, right? And the year to 2 to 5 is basically you make the mistakes yourself, you learn everything, you realize that a lot of times that you won, you got lucky. And so you have to, make a trading journal or investing journal, if you will, and, build from the ground up again. So 2 years, 2 to 5 is kind of like learning to relearn old bad habits and reading the same books that you read in year
Mm,
one, but you didn't understand it. Like,
perspective.
every kid that graduated out of top school said, "Oh yeah, I read Intelligent Investor." Okay, great, but like no one really knows. I mean, half of Wall Street didn't even know what rates will do to their growth stocks last year, right? Or 2 years ago. So, like, how have you told me that you really internalized Intelligent Investor? Okay. And then, so when you get, onwards, 5 years plus, 10 years, whatever, I think for that, it's starting to get a little creative, start to like integrate different ways of investing in different frameworks to kind of find your edge, or your system, if you will. And that's what I'm really trying to learn myself right now, which is, I've been brought up in the more thematic, long term growth investing mindset from a fundamental standpoint. I realized, me, many of our peers got completely wiped, the past 2 years. And so, wait, I got to learn macro.
Mm,
And then with the volatility, literally each month that you accumulate a stock, because the market is no longer monotonic up and to the right anymore, the volatility, your entry points matters. I've learned that even trading is important, right? And hence we built our relationship that way. And so, you start to add in different methods, right? You don't have to be too cute and fancy and go overboard. You could stick to your areas of strength, but add different angles that they give you edge, because that intersection is really what um, gives a lot of alpha nowadays. Since a lot of data is out there, it's how you combine it into a system that works for you. That's that's really what matters. And that kind of goes full circle to year one, which is like nothing changes, right? Like you're always going to be either like a short-term swing trader, or you're always going to be a long-term investor. But even as a long-term investor, you could get better entry points, which over time compound your gains. If you knew how to read the macro, or at least get it directionally right, and then also from a risk reward standpoint on a trading, where to enter your price. These little things over time is a difference between, like a 50% gain on a position or like a 30% gain, right? And
mm.
so I think that refining that is what I'm learning now. And this is what I mention for folks who are 5 to 10 years in their journey, if you will.
It's a cool, like, yeah, full circle moment of going back, being willing to sharpen that sword, relearn things, add little tools to the shed. I like the 2 to 5 year one. It's like a window of like learning from your mistakes and realizing, like, it's a self accountability window where you're really like, if you're not willing to learn and accept those mistakes, you're just gonna end up not getting past year 5. And if you do, then you finally start to develop that disciplined game, and then you can actually say that, like, yeah, this is my game, this is my style. And then from there it's like a refine, 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 refine. And now that you have this refined game, you can start adding those new things into it, because it's not gonna you have that kind of solid foundation you've built. It's like, I'm gonna write up a tweet sometime, because as you were saying that, I was saying it's like exactly like jujitsu. I like to think of maybe is like you have this white belt mentality of learning. You have the blue belt and purple belt, which everybody's kind of learning new moves, making mistakes, messing up, learning, kind of understand. They've gotten past the basics at this point, but they're finding out what works, what doesn't work. And then brown belt and black belt are people, they've now formed their style, their game. They're just refining it over and over. And then they have this saying that once you're a black belt, you become a white belt again, in that, like, you have this proven black belt kind of style, but now you're just a white belt of black belts, and you need to go back. Maybe it's giving back and teaching the fundamentals again, which will then make you better, because you now have read that book again, right? So yeah, pretty cool, interesting, different perspective.
Yeah, for sure. And I think one way to know that you're on the right track is when you realize after 1 year that you actually don't know anything,
Yeah.
right? I think that when you first learn investing or trading, it's like you make one trade or whatever, and it's like, wow, this is so easy. I just need to do that. Need to do that a few more times, and it's done, right? That's usually like,
Those
depending on
God
how quick
changes.
you learn, month 6 in or month 7 in, you're like, wow, this is easy. And then, you're starting to make headwind when you're like, you know, year 1.5 or 2 years in, you're like, holy shit, this is really hard
Yeah.
to do it
Yeah.
consistently.
I remember
It's
those times. Year and a half in, I'm just like, Jesus Christ, this is not what I was thinking. Yeah.
Yeah, one of the funniest things I always see on Twitter is when you have um those those gurus, if you will, say like, oh look, you can join my Discord group and learn how to make, you know 1% on your P&L per day. All you got to do is just repeat it, 200 days this year, and then
Sounds
you'll
great
be
to
worth
me.
$10 million.
Sounds really easy. I gotta sign up for that.
Yeah, just 1% a day.
All right. Well, Alchemist Investor guys, go give them a follow. Thanks for taking some time out. I think that was a really cool discussion, and I think people are going to learn a lot.
All right, really appreciate it, James. It's always fun to chat, and I think even from this discussion alone, a lot of follow-ups in our subsequent spaces. So, really appreciate your time as well.
Cool. All right. Have a great day. See you
All
later.
right, take care.